What's up, everybody? Welcome back to Ang's channel. Today we're back to another Russell 2000 stocks. Today we'll be looking at Carvana Corporate, called the CVNA. So without further ado, let's get right into it. So over here we can observe the trend of this stock or this company is actually very strong, right? You can see from the year of 2000, end of 2023 up until now, it has been going up around 10x or 10 times the price. But if you pull back a bit, we can actually observe that this company actually experienced a huge dip, and only then it starts to show its strength again, going back up to its recent all-time high. Whether or not if these stocks will then keep on going up and break the all-time high, we'll be looking at their financial fundamentals as well as their business model in order to evaluate it. So over here we have the revenue of the Carvana, and as you can see, the revenue is actually in a very decent form of increasing trends. So up until the latest quarter, it's actually breaking the all-time high in terms of revenue since it's been created during the year of 2022. As for the net income of this company, it's not quite that fascinating because of a very decreasing trend or a negative form of net income. So one of the reasons why Carvana actually experienced a huge sink or huge drawdown is maybe due to the fact that they are actually facing a decreasing form of net income, meaning that they actually have a more accumulation in terms of their losing money, and only after the year of 2023 the net income starts to show a growing sign of positive. And during the year of 2023, the September quarters, there is a huge surge in the net income, which can be one of the reasons that drives the stocks to continue going up to its all-time high. As for the free cash flow of Carvana, you can actually see it's the same thing as the net income during the year of 2021 until 2023. It experienced a very poor financial statements, and only for the recent year of 2023 and 24 starts to show a positive free cash flow, which is something that I would prefer to look at, and it actually takes more observation or years in order to see whether or not in the future years they will be able to achieve higher and better free cash flow. So after looking at their financial status, let us look at what does actually Carvana do. So based on this, it's actually a e-commerce platform or a digital platform. They sells or buy cars in the United States. So what they actually do, they include the sales of retail vehicle, wholesale vehicles. They have financial services including the loans and also commissions on vehicle services, contracts, waiver coverage, as well as trade-in of vehicles. Basically, their stream of income includes the main revenue driver, which is selling the used car directly to consumers. They also have wholesale vehicle sales, which is selling vehicles which does not meet the requirement of retail cars through wholesale like auction and so on. And third is going to be their financial services, the loan sales. They gain on the sale of loans, servicing fees, and have ancillary products, which includes the vehicle service contracts. They have the extension of warranties, waiver coverage, and insurance referral fees. And finally, it's going to be the trade-in arbitrage, which buying vehicles from customers, sometimes selling them a car in the return, so they will be profiting from that difference of price. So one of the strengths of this company is actually its first digital model, because it's actually a first mover in terms of fully online used car buying and selling experience, which can be very convenient, transparent, as well as reduce the traditional infrastructures. Second of all, is going to be a strong brand recognition in US. They have this integration, vertical integration, whereby they provide the services including from selling the vehicles to provide insurance, loan, as well as their coverage and so on. And fourth is going to be their nationwide reach, high revenue growth potentials, as well as operational data advantage. As for the weakness, it actually has a very decent value of high debt levels. So we haven't gone through the cash as well as the debt to equity ratio. We'll be looking at that in sooner. And the second is going to be their thin margins in used car industry. So even in financing income, the margin can be low and high sensitivity to inventory cost as well as the vehicle depreciations. It also has the past profitable struggles, as we mentioned, from 2021 to 2023. The net income is actually in very negative form until the end of 2023, where it starts to show a positive and a very huge surge during one of the quarters in 2023. So now let's look at the reason why is the sudden surge of the net income in one of the quarters in 2023. So that is during Q3, whereby the net income actually saw to 700 millions, and this is actually driven by a gain on debt extinguishment. So essentially, accounting recognition of gains from restructuring or retiring debt on favorable terms. So meaning that they actually cancel out some debts or they actually restructure it. So the main reason is actually a gain on debt reductions and maybe restructuring. And also, as we observe, their sudden surge does not actually sustain, and the net income actually drops down, although it's still in a positive form, but it's still very unpredictable and not in an increasing trend. So the net income surge, right, cannot be sustained because of driven by non-recurring events. So the case, as we mentioned, is because of their gain on debt extinguishments. So it's not on their sales being increased or they actually reduce a lot of debts or they actually reduce their operating costs, meaning that it's just a one-time accounting gain and they don't actually provide minimal services that increase the revenue, which eventually leads to a positive or higher net income. But they still have a very high in terms of debt despite having it to restructure or maybe they extinguish some of it. So after looking at what they do as well as some of the reasons behind the surge of the sudden net income as well as why it cannot sustain, let's go back to the ratios, whereby first of all we'll be looking at the debt to equity ratio. This debt to equity ratio, as mentioned about the weakness, is that it has a very high debt, and the reason why Carvana cannot sustain its very high net income is due to a high debt, which they need to pay a lot of interest, which will dilute its profitability, and because of the debt equity ratio of almost at 3. So my criteria is that if it's above 1, it's actually a company that's very dangerous with a lot of debt. And as for the ROE, also as for the ROE, the value actually starts to become positive and increasing in the value above 15%, and similar case for the ROIC. However, it's just haven't reached that level of 15, but the level of 12% is actually pretty decent. Finally, we'll be looking at the net cash of this company, whereby you can actually kind of predict it. Yeah, because of the high debt situation of this company, which will result that the company will have more debt than their cash. So this kind of company can be quite dangerous because of the requirement of the company to pay off their interest for the debts or the loans, which can affect and reduce their profitability. In the long term, if they did not actually reduce their debt or restructure it, it can be a compounding method for the company, which they need to pay more money and lose their profits. So that is all for the ratios but fundamentals. The situation of this company is that the business model, it has a very good first mover advantage when it comes to the digital platform in terms for the retail car services, and also have vertical integrations. It's just that the situation whereby the profitability of this company is very low. So a sudden surge of one of the quarters in 2023 is just a one-time accounting gain, which does not mean that this company actually provides a services or products where it will actually increase the sales. It's just that it's a one-time restructuring of the debt or extinguishing event. And lastly, we'll be looking at the economic moat score for Carvana company. And first is going to be their loyalty, branding, pricing power. It's scored at 6, and high barriers to entry is at 7. The switching cost is at the value of 5, which is very low, as it can be less costly for the consumer to switch to other platforms. Their network effect of 6 and economic scales of 7. So the overall scores for the economic mode is actually at 6.2. So it's considered as a narrow to moderate mode. And they also mention certain limitations whereby they have high competitive pressures, as mentioned, where we have the very low high switching costs and also the uncertainties around its company's ability to provide and to generate profits throughout the time. Some of the analysis context is that the Oppenheimer and Morgan Stanley actually is quite positive about the sentiments of this company, but for the ecomod.ai website is actually saying that the Carvana is sitting at a situation of no moat, which can be affected by the situation of high competitions in the same market as well as of its low switching costs. So that is it for this company. We look at the financial status, the business model, as well as the economic mode, and overall the direction and the sentiments for this company, in my view, is that this company is actually in the phase whereby it's actually in the growing price trend. It's just that I would not willing to purchase this company because of its weak mode as well as its debt situation. It can be very dangerous when it comes to the case of high interest rates. However, in the recent times, right, we are actually expecting a rate cuts during the meeting of September. So hopefully that happens. Maybe there will be a booster for this Carvana company. But at the meantime, I will actually stay away from this company because of its very high debt than cash, which can be a threat toward its profitability. So yeah, I guess this is all for the Carvana company. And if you're interested with this business model, you can actually go into detail and to understand this company and do your due diligence before you make your decisions in whether or not you want to invest in these investment tools. So that is all for today's video. I hope this video actually helps you and gain information. And if you would like to support me, you can actually click the thumbs up, subscribe to my YouTube channel, as well as share the video to your friends. So I guess that is all for today. I'll see you on the next one. Goodbye.